December 18th, 2025, 11:42 a.m. EST, silver crossed $79 per ounce for the first time in 45 years, and within minutes, something extraordinary began happening across global markets. Tesla stock dropped 7% in the first hour, Apple fell 5%, NVIDIA crashed 12%. The entire NASDAQ technology index was bleeding red, while silver continued its relentless climb toward $80. This wasn't coincidence. This was the moment the technology sector discovered that their entire business model depends on a single metal that governments can no longer keep cheap through monetary manipulation. And as silver prices expose the physical limits of infinite growth narratives, the most overvalued sector in history is about to confront the mathematical impossibility of its current valuations. I kept watching the correlation strengthen throughout the trading session. Every dollar silver gained, technology stocks lost $50 billion in market capitalization. By market close, silver had reached $79.85, while tech stocks had suffered their worst single-day performance since March 2020. But this wasn't panic selling. This was rational repricing based on the recognition that technology companies cannot function without silver, and silver can no longer be obtained at prices that support current profit margins. The age of infinite digital growth just collided with finite physical reality, and physical reality is winning decisively. What this really means, the death of the tech bubble. For 2 decades, technology stocks have traded on the assumption that digital innovation could transcend physical limitations. Software companies with no tangible assets commanded higher valuations than manufacturing companies with billions in physical infrastructure. The entire new economy narrative was built on the premise that bits and bytes matter more than atoms and elements. But every piece of technology, from smartphones to data centers to electric vehicles, depends absolutely on silver for conductivity, thermal management, and electromagnetic shielding. You cannot build a computer without silver. You cannot manufacture solar panels without silver. You cannot operate 5G networks without silver. Silver at $25 per ounce was irrelevant to technology valuations. Silver at $79 per ounce represents an existential crisis for companies whose profit margins depend on cheap access to irreplaceable materials. The input cost revolution. When silver was $25, it represented roughly 0.3% of total manufacturing costs for a typical smartphone. At $79, silver represents 2.4% of manufacturing costs, an 8x increase that cannot be absorbed through efficiency gains or alternative materials. Apple's iPhone contains approximately 0.35 grams of silver. At $25 silver, that represented 0.28 in material costs. At $79 silver, the same amount represents 0.89, a $0.61 increase per device. Multiply by 200 million iPhones annually, and Apple faces $122 million in additional silver costs alone. But Apple is the efficient manufacturer. Tesla's Model S contains roughly 1.5 ounces of silver per vehicle. At $25 silver, that was $37.50 in materials. At $79 silver, it's $118.50, an $81 increase per vehicle. For Tesla's 2 million annual production, that's $162 million in additional costs. The scaling problem. These calculations assume current production levels, but every technology company has growth plans that require massive increases in silver consumption. Tesla plans 20 million vehicles by 2030. Apple targets 300 million iPhones annually. Google is building data centers that require 50 pounds of silver each. At $25 silver, these growth plans were economically viable. At $79 silver, they become prohibitively expensive unless companies raise prices so dramatically that demand destruction occurs. The substitution. Myth. Technology executives claim they can engineer around silver shortages, but physics disagrees. Silver has the highest electrical conductivity of any element. Silver has optimal thermal conductivity for heat dissipation. Silver has antimicrobial properties essential for medical devices. You can substitute inferior materials, but you sacrifice performance, reliability, and efficiency. In competitive technology markets, products that work worse than competitors fail regardless of cost advantages. Historical pattern layer. When resource constraints destroy growth stories, history provides clear examples of how resource limitations have destroyed entire sectors built on assumptions of infinite cheap inputs, and technology stocks are following this pattern precisely. The automotive industry, 1973-1979. American car manufacturers dominated global markets through the 1960s based on cheap oil that made large, inefficient engines economically viable. When oil prices rose from $3 to $35 per barrel, the entire industry nearly collapsed as consumers shifted to fuel-efficient Japanese alternatives. General Motors stock fell 78% between 1973 and 1979. Ford lost 65%. Chrysler required government bailouts to avoid bankruptcy. The companies that had seemed invincible when oil was cheap revealed themselves as fundamentally unsustainable when input costs reflected scarcity. The aluminum industry, 1970-1985. Aluminum production requires massive electricity consumption, roughly 13,000 kilowatt per ton of metal. When electricity prices tripled during the 1970s energy crisis, aluminum smelting became uneconomical in high-cost regions. Alcoa closed 20% of domestic capacity. Reynolds Metals eliminated 15,000 jobs. Kaiser Aluminum filed for bankruptcy protection twice. The industry that had grown exponentially during the cheap energy era contracted violently when energy reflected true scarcity costs. The construction boom, 2000-2008. Home building companies achieved spectacular growth during the housing bubble based on unlimited cheap credit and steadily rising prices. When credit tightened and prices began reflecting mathematical reality rather than speculation, the entire sector imploded. Toll Brothers fell 91% from peak to trough. Pult Homes dropped 89%. Centex Corporation was acquired for 15% of its peak value. Companies that had traded like technology growth stocks revealed themselves as cyclical commodity businesses when input costs, capital, returned to market-determined pricing. The pattern. In every case, industries built on assumptions of permanently cheap inputs experienced devastating corrections when those inputs began trading at prices that reflected genuine scarcity rather than artificial abundance. Technology companies have built their valuations on the assumption that silver, lithium, cobalt, and rare earth elements will remain cheap forever. Silver at $79 is the market's way of saying that assumption was wrong. Modern data layer. The technology. Silver consumption crisis. The scale of technology sector vulnerability to silver prices becomes clear when you analyze actual consumption data rather than relying on corporate statements that minimize material cost exposure. Smartphone industry. Silver demand. Global smartphone production consumes approximately 240 million ounces of silver annually across 1.4 billion devices. At 25 silver, this represented $6 billion in material costs. At $79 silver, the same consumption costs $18.96 billion, a $12.96 billion annual increase that must be absorbed through higher prices or lower margins. Apple, 200 monitor devices, additional 122 monitors annually. Samsung, 180 monitor devices, additional 110 monitors annually. Xiaomi, 150 monitor devices, additional 91 monitors annually. Oppo Vivo, 280 minutes combined, additional 170 annually. Other manufacturers, 590 monitors devices, additional 359 money annually. Data center silver requirements. Each hyperscale data center requires 50 pounds of silver for servers, networking equipment, and power distribution. With 500 plus new data centers planned globally through 2027, the industry faces 15,000 to 25,000 pounds of additional silver demand annually. At $25 silver, $12-20 million in material costs. At $79 silver, $63 million in material costs. Google, Amazon, Microsoft, and Meta each operate 200 plus data centers with expansion plans requiring billions in additional silver procurement at current prices. Electric vehicle silver explosion. EV production consumes 3x more silver than traditional vehicles due to battery management systems, power electronics, and charging infrastructure. With 15 million EVs planned for 2026 production, the industry requires 45 million ounces annually. At $25 silver, $1.125 billion material costs. At 79 silver, $355 billion material costs. Tesla, BYD, Volkswagen, and other EV manufacturers face $2.43 billion in additional silver costs that cannot be eliminated through design changes without sacrificing performance. Solar industry. Silver dependency. Solar panel production requires 20 grams of silver per panel for conductive paste applications. With 300 $G of new capacity planned for 2026, the industry needs 200 million ounces of silver annually. At $25 silver, $5 billion material costs. At $79 silver, $15.8 billion material costs. First Solar, Jinko Solar, and other manufacturers face $10.8 billion in additional costs that make renewable energy significantly more expensive, just as government subsidies are declining. The aggregate impact: combined technology sector silver consumption exceeds 500 million ounces annually, more than half of global mine production. At $79 silver versus $25 silver, the sector faces $27 billion in additional annual costs that must be passed through to consumers or absorbed through margin compression. For context, this cost increase exceeds the total annual profits of Apple, Microsoft, and Google combined in 2024. The hidden mechanism: why governments cannot fix this? The most significant implication of silver reaching $79 is not the immediate impact on technology companies, but the demonstration that governments have lost control over critical commodity pricing despite unlimited money printing and regulatory authority. The Federal Reserve limitation. For 50 years, the Federal Reserve has maintained monetary stability by controlling interest rates, money supply, and financial market liquidity. But you cannot print silver. You cannot set silver interest rates. You cannot create silver through quantitative easing programs. When silver prices rise due to genuine physical scarcity, monetary policy becomes irrelevant. The Fed can lower interest rates to zero and print trillions of dollars. But silver prices will continue rising because the underlying supply-demand imbalance cannot be solved with monetary policy. The strategic reserve depletion. The U.S. Strategic National Defense Stockpile contains only 20 million ounces of silver, less than 3 weeks of global consumption. Previous administrations sold most reserves during the 1990s and 2000s when silver traded below $10 per ounce. Releasing all remaining reserves would provide temporary price relief lasting approximately 20 days before markets resumed their upward trajectory based on fundamental supply deficits. The international coordination failure. Silver is mined in Mexico, 25%, Peru, 18%, China, 14%, Chile, 11%, and Russia, 8%. Coordinating international intervention requires cooperation between nations that are increasingly hostile to each other. More importantly, producer nations have no incentive to suppress silver prices when higher prices increase their export revenues and strategic leverage over technology-dependent economies. The substitution engineering limits. Government research agencies have spent billions trying to develop silver substitutes for critical applications, but physics imposes absolute limitations that cannot be overcome through innovation or investment. Silver's electrical conductivity is 6% higher than copper and 63% higher than gold. No known material provides superior conductivity at comparable costs. You can use substitutes, but you sacrifice performance. The production constraint reality. Silver ore grades have declined 65% over the past 30 years as easy deposits have been exhausted. New mine development requires 7 to 15 years and faces increasing environmental restrictions, labor shortages, and political instability in producer countries. Governments cannot accelerate mining timelines without abandoning environmental and safety regulations that protect public health. The choice is clean air or cheap silver, and political pressure favors environmental protection. The recycling mathematics. Only 15% of silver consumption is recovered through recycling due to dispersed industrial applications. Unlike gold jewelry that can be melted down, silver in electronics exists in microscopic quantities that cost more to extract than the recovered metal is worth. Governments cannot mandate recycling economics that violate basic cost-benefit analysis. Silver will remain in landfills regardless of regulatory requirements or subsidy programs. Eruption scenario. The tech stock cascade. Based on current silver price trends and technology sector cost structures, here's how the tech stock collapse will unfold as silver continues rising toward $100+ per ounce. Phase 1. Margin compression. $79, $85 silver. Technology companies will initially absorb higher silver costs through reduced profit margins rather than raising prices and losing market share. This will show up in quarterly earnings as supply chain headwinds and temporary material cost pressures. Apple's gross margins will fall from 38% to 35%. Tesla's automotive gross margin will drop from 19% to 16%. NVIDIA's chip margins will compress from 75% to 70% as silver-intensive graphics processors become more expensive to manufacture. Phase 2. Price increases. $85, $95 silver. As margin compression becomes unsustainable, companies will begin raising prices across product lines. iPhone prices will increase $100, $150 per device. Tesla will add $2,000, $3,000 to vehicle prices. Data center services will become 15 to 20% more expensive. Consumer demand will begin falling as technology products become less affordable. Replacement cycles will lengthen as people delay purchases. Corporate IT spending will decrease as higher prices force budget reallocation. Phase 3. Demand destruction. $95, $110 silver. Higher prices will trigger significant demand reduction across technology categories. Smartphone sales will fall 20 to 30% as consumers extend replacement cycles from 2 years to 3+ years. EV adoption will slow as price increases offset government incentives. Technology companies will face the choice between maintaining margins by raising prices further or maintaining volume by accepting unprofitable operations. Most will choose volume initially, leading to massive earnings disappointments. Phase 4. Capacity rationalization. $110+ silver. Companies will begin shutting down silver-intensive product lines and manufacturing facilities. Apple will discontinue lower-margin iPhone models. Tesla will delay Cybertruck production indefinitely. Data center construction will slow dramatically. Mass layoffs will begin as companies adjust operations to smaller addressable markets. Stock prices will fall 50-70% from current levels as investors recognize that previous growth assumptions were based on permanently cheap silver that no longer exists. Phase 5. Industry consolidation. Smaller companies will fail entirely as they cannot absorb silver cost increases. Larger companies will acquire assets at distressed prices and consolidate production in the most efficient facilities. The technology sector will stabilize at much lower valuations, reflecting the new reality of expensive critical materials. Growth rates will fall from 15 to 20% annually to 3 to 5% as physical resource constraints replace financial engineering as the primary business limitation. The warning, the end of infinite growth. Silver reaching $79 represents more than just a commodity price increase. It represents the moment when physical reality begins constraining financial assumptions that have driven technology valuations to unsustainable levels. The valuation reckoning. Technology stocks trade at an average P/E ratio of 35x compared to 16x for the S&P 500. These valuations assume unlimited growth based on infinitely scalable digital products. But when digital products require physical materials that cannot be scaled infinitely, the growth assumptions collapse. The government impotence. For the first time since World War II, markets are discovering limits that government intervention cannot solve. You cannot print silver. You cannot regulate physics. You cannot mandate abundance of scarce materials through legislation or monetary policy. This represents a fundamental shift from financial markets driven by policy to physical markets driven by geology, chemistry, and thermodynamics. The investment implications. Investors who remain positioned in technology stocks expecting government intervention to restore cheap silver will discover that some problems cannot be solved through monetary or fiscal policy. Physical scarcity requires physical solutions that take decades to implement. Meanwhile, investors positioned in physical assets and companies that control critical materials will benefit from scarcity pricing that reflects true value rather than manipulated abundance. The societal transition. The technology boom of the past 30 years was built on artificially cheap inputs that made digital innovation appear infinitely scalable. As input costs rise to reflect genuine scarcity, society will discover that many essential technologies are actually luxury items that become unaffordable when materials trade at market-determined prices. The timeline acceleration. Silver's rise from $25 to $79 represents a 216% increase that demonstrates how quickly scarcity pricing can emerge when artificial suppression mechanisms fail. The technology sector correction will happen faster than most investors expect because the underlying mathematics are unforgiving. The individual response. For ordinary investors, silver at $79 provides a clear signal about the direction of material costs and technology valuations. Those who recognize the pattern and position accordingly will preserve wealth during the transition. Those who believe technology stocks are temporarily oversold will discover that some corrections are permanent. The age of infinite digital growth has ended not because innovation stopped, but because the physical materials required for innovation are no longer available at prices that support infinite growth assumptions. Silver at $79 is the market's way of saying that atoms matter more than bits, scarcity matters more than speculation, and physics matters more than financial engineering. Technology companies are about to learn these lessons the hard way. The question is whether investors will learn them early enough to protect themselves from the cascade that's already beginning. The correction has started. The fundamentals guarantee it will continue, and the mathematics ensure it cannot be stopped through government intervention or corporate innovation. Silver doesn't care about stock valuations, growth targets, or investor expectations. Silver cares about supply and demand. And at $79 per ounce, silver is telling us that demand has permanently outstripped supply in ways that will reshape the entire technology sector. The bubble is bursting, not because of speculation or sentiment, but because reality has finally overwhelmed the financial fiction that infinite growth is possible in a finite world.